Are you ready to make 2024 your best year yet for investing? Before you dive into the world of stocks, real estate, and crypto, let's make sure you avoid the pitfalls that can cost you thousands. Today, we'll reveal the top 5 investment mistakes to steer clear of in 2024. Stay until the end to learn how you can protect your hard-earned money and grow your wealth smarter. All right, let's dive right into mistake number 1, chasing short-term gains. In today's age of meme stocks and viral crypto tokens, it's easy to get caught up in the excitement of quick profits. But here's the hard truth: trying to time the market, trying to perfectly predict when to buy low and sell high. It can be a gamble, even for seasoned investors. It's like trying to catch lightning in a bottle. You might get lucky once or twice, but it's not a sustainable strategy for long-term wealth building. Instead of chasing the next hot stock tip, focus on a long-term investment strategy. Think of it like building a solid foundation for a house. You don't want to build it on shaky ground, right? You want something that can weather the storms, the market ups and downs. Remember, wealth is built over time, not overnight. It's about consistency, discipline, and making smart decisions that align with your financial goals. Prioritize that consistent growth and avoid those risky trades that are purely driven by hype. Don't let FOMO, the fear of missing out, dictate your investment decisions. Be patient, stay focused on your long-term strategy, and don't get sidetracked by the allure of quick riches. Remember, slow and steady wins the race, especially in the world of investing. Let's move on to mistake number 2, not diversifying your portfolio. Imagine this: you've poured all your hard-earned money into one trending stock. Everyone's raving about it, the charts are going through the roof, and you're feeling pretty good about your decision. But then, the unexpected happens. Maybe there's a shift in the market, some negative news comes out, or maybe it was just pure speculation all along. Whatever the reason, that stock you put all your faith in, it plummets overnight. Suddenly that feeling of excitement turns into panic. You watch helplessly as your investment shrinks before your eyes, and you realize you've put all your eggs in one very fragile basket. That, my friends, is why diversification is so crucial. It's your safety net in the unpredictable world of investing. A well-diversified portfolio spreads your risk across different asset classes, industries, and even geographical regions. It's like having multiple backup plans, so you're not reliant on just one single investment for your financial well-being. By balancing your investments in stocks, bonds, real estate, and even alternative assets like cryptocurrencies, you create a safety net that can cushion the blow if one area of the market takes a downturn. Remember, diversification is not about avoiding risk altogether, it's about managing it intelligently. So don't put all your eggs in one basket. Diversify your investments, spread your risk, and create a portfolio that can weather the inevitable storms in the market. Chapter 3. Ignoring compound interest. Now let's talk about a mistake that many people make, especially those who are just starting out with investing. Mistake number 3. Ignoring the power of compound interest. And trust me, if you're not harnessing the magic of compounding, you are leaving serious money on the table. Compound interest is like this secret weapon that allows your investments to grow exponentially. It's the snowball effect in action, where your gains start earning gains of their own, and those gains earn even more gains, and so on. The earlier you start, the more time your money has to compound and grow. Imagine this: you invest just $100 today, and it earns a modest 7% return per year. Now you might think, okay, 7% of $100, that's not a lot. But hold on, because here's where the magic happens. Over time, that $7 return gets reinvested. So, the next year you're not just earning 7% on your initial $100, but on $107. And the year after that, on even more. Fast forward 30 years, and without adding another dollar to your investment, that initial $100 has grown to almost $800. That's the power of compounding. So, how do you make compound interest work for you? Start early, invest consistently, and reinvest your earnings. Even if you can only afford to invest a small amount each month, it can add up to significant wealth over the long run, thanks to the magic of compounding. Remember, time is your greatest asset when it comes to investing. So don't delay, start investing today, and let compound interest work its magic on your portfolio. Chapter 4. Investing without proper research. Now for mistake number 4, investing without proper research. The market is absolutely flooded with hot tips, get-rich-quick schemes, and investment trends that promise astronomical returns. You've probably seen the headlines: This stock is going to the moon, or this crypto is the next Bitcoin. It's easy to get caught up in the hype and FOMO, but here's the thing. Just because an asset is popular, or everyone's talking about it, doesn't mean it's a good fit for your portfolio. Before you put your hard-earned money into any stock, fund, or crypto asset, you need to do your homework. Don't just rely on what you see on social media or hear from your buddy at the gym. You need to understand the fundamentals. What drives the value of this particular investment? What are the risks involved? What's the company's track record? Are they profitable? Do they have a solid business model? These are the questions you need to be asking. Due diligence isn't just for Wall Street hotshots, it's essential for everyone, no matter how much money you have to invest. Think of it like this. You wouldn't buy a house without getting it inspected first, right? You wouldn't just hand over hundreds of thousands of dollars without knowing what you're getting yourself into. So, take the time to research any investment before you hit that buy button. Knowledge is power, and in the world of investing, it can be the difference between making a smart investment and losing your shirt. Chapter 5. Emotional Investing. Alright, let's talk about the final and perhaps the most dangerous investment mistake: emotional investing. Now we're all human, and it's perfectly natural to feel a roller coaster of emotions when it comes to our money. When the market is soaring, you might feel invincible, like you can do no wrong. You start picturing all the amazing things you're going to do with your newfound wealth. But then, the market takes a dip, and suddenly those feelings of euphoria turn into fear and panic. You start doubting your investment decisions, questioning everything you thought you knew about the market. And that, my friends, is when emotional investing can absolutely wreck your long-term financial goals. Successful investors understand that the market is cyclical. There will always be ups and downs, periods of growth and periods of correction. Instead of letting their emotions dictate their investment decisions, they stay disciplined. They create a plan and they stick to it no matter what the market is doing. They don't panic sell when the market dips because they know that's often the worst time to sell. And they don't get caught up in the hype when the market is soaring because they know that FOMO can lead to irrational decisions. So how do you avoid emotional investing? Create a solid investment plan that aligns with your risk tolerance, your financial goals, and your time horizon. Automate your investments as much as possible. This takes the emotion out of the equation and ensures that you're consistently investing, regardless of what the market is doing. Remember, investing is a marathon, not a sprint. It's about making smart, informed decisions over the long term, not about trying to get rich quick. Avoiding these 5 common investment mistakes could make all the difference in achieving your financial goals in 2024. Remember, investing is a journey, not a get-rich-quick scheme. It's about making informed decisions, staying disciplined, and focusing on the long term. If you found these tips helpful, don't forget to like this video, subscribe to AI-SmartInvestor for more AI-powered investment insights, and hit that bell icon to never miss an update. What's the biggest investment mistake you've seen or made? Share it in the comments below and let's learn together.